So positioning of the portfolio remains fairly stable, actually. And a lot of that is set by the structure of the trust. We have the equity portfolio delivering total return and high yield, a preference share portfolio which delivers a stable level of very high yield, and then a smaller company's exposure as well. And that structure, which gives a really good balanced return, stays the same. Within the equity portfolio, where we've got a bit more flexibility, we haven't changed sector exposure an awful lot recently. That aim of having balance and having a real variety of sources of income remains the same, and we remain very balanced by sector. But what we have been doing is taking off a little bit of defensive exposure within the portfolio after the first 6 months of last year, when actually being defensive was good, and trying to find both stocks that are high yields again, and also those stocks where they have really good growth prospects for the long term, but where they have derated as markets have pulled back somewhat last year. Performance last year overall lagged the benchmark slightly, and that's probably what we'd expect, because we do have that big block of more fixed income-like investments in the preference shares that will underperform when bond yields go up, and that's exactly what we saw last year. So no surprises there, and those instruments continue to do their job and deliver a very high level of income. The equity portfolio outperformed the benchmark, which was good. And as we saw that headwind from rising interest rates, rising bond yields start to dissipate somewhat in the second half of the year, then the trust performed more in line and actually outperformed the benchmark in the last 3 months of the year. The other side of the equation for us is always income as well as capital return. And the income outlook has continued to improve. Dividends were stable at the half year, having grown post the pandemic, and still delivering a very attractive 5.5% dividend yield. And as we look forward, income projections actually look pretty healthy. So that important part of the outcomes that we're looking for looks good and is performing well. Key portfolio changes over the last 6 months. When we think about what we've done, it's been very stock specific. So trying to always be active, find new ideas and find good companies which we think will deliver income over the long term. And the things we've been buying really fit into two buckets. Either those things that are derated somewhat and now offer a really high yield. So some good examples of that would be Legal & General in the UK, which was delivering an 8% yield and derated quite substantially as we went through the turmoil of September's mini budget in the UK. And that's a good opportunity for us to buy into a long-term stable company. Another example would be Engie, which is a French utility, which also has a very high level of yield and looks attractively set for the long term. Conversely, we've also been buying those things that maybe don't have such high headline yield, but offer really good quality and growth, and derated a little bit last year as markets came back. So names like Kone, Marshalls, are good quality companies which we think will grow long term, but were a bit weaker last year, and that gives us a really nice entry point. Things we've been exiting, also some of the defensive exposure that held up well last year, but in our view offers us less total return potential in the long term. So utilities we reduced, and also some property exposure where we see that impact of higher rates being quite meaningful in terms of those companies' ability to grow income and to deliver a total return in the near term. So two recent new holdings for us that I think are interesting for different reasons are Decra and Dr. Martens. And Decra is a really good quality company. It's one we've held in the portfolio before. We sold it back in 2021, and it provides veterinary pharmaceuticals, which is a great business, strong structural growth drivers, good profit margins, and it's a company which has a very good niche in what it does. It was one that back in 2021 simply looked too expensive from our point of view. The multiple was very high, the yield had compressed, but as we went through last year, like a lot of more growthy quality stocks, that multiple came back down, the yield was back up again, and we could get back into this long-term growth story at what we thought was a reasonable valuation. So buying that kind of thing, really interesting, and Decra is a great company. I think we'd be happy to own for many years until it gets too expensive again. The other example is maybe looking at something which is much more in the value cap. Dr. Martens, and that kind of consumer and retail exposure has been very out of fashion in recent years. But in that space, companies can build quality, they can build a long-term business, particularly if they've got a strong brand. And that Dr. Martens brand is something that has an awful lot of history. It has a lot of potential to grow in the rest of the world, and it is actually delivering very good growth at the moment. That company's been through some short-term issues around its logistics as it grows, but we believe those short-term issues will pass. And after a recent profit warning off the back of that, it was a really good opportunity to buy a company at less than 10 times earnings, 4% dividend yield, but still with the potential to compound revenue and earnings over a long period of time. So something we're in the portfolio, we don't have a lot of consumer exposure. So where we find those opportunities, quite keen to take them and diversify a little bit. So I think the themes we're looking to play stay consistent. We are looking for good quality companies with a high level of income and an overall portfolio that balances risk and delivers a good total return over time. And the types of things we're looking for don't change. I think at this moment in time, economic outlook is reasonably uncertain. Equity valuations compared to where they were 18 months or so have pulled back. And it's a good time to kind of sift through all the uncertainty that's out there and find those good stocks which will outperform the index. I don't think it's like last year where we had a very clear view that the market would be pro-value over growth and that growth was overvalued. I think now it's a much more balanced market, but that makes it a good market for trying to pick the right stocks and just refocus on finding those high quality names that can outperform the market over the long term. And that's the bedrock of what we do and what hopefully delivers good returns.